This podcast is brought to you by the IIEA, sharing ideas, shaping policy.
Good afternoon and welcome to the Institute of International and European Affairs. It's a great pleasure to welcome back one of the executive members of the European Central Bank to speak again with us, and the Deputy Governor of the Central Bank of Ireland. So our speakers today are Frank Elderson, who's, as I said, a member of the Executive Board of the Governing Council, and he's Vice Chair of the ECB's Supervisory Board, who oversees the ECB's legal services. Sharon Donnery is Deputy Governor of the Central Bank of Ireland for Financial Regulation, and she's also a member of the Supervisory Board of the European Central Bank and the General Board of the European Systemic Risk System. As we were saying earlier, the structures of the central banking system in Europe are a little bit complicated, but very good to have you both. So today's event, Frank is going to speak for about 20 minutes, mostly focusing on how climate-related issues affect the role of the central bank and the supervisory functions, and Sharon will also give a response, and we'll be open to questions. Most of our participants today are online, so we will take questions from those online, but we will be giving preference to people who have questions in here in the in-person audience. So with that, Frank, you're very welcome. The floor is yours.
Well, thank you so much, and welcome also on my part here, and to the Institute of International European Affairs for inviting me, and also to the great to be here with you, Sharon, on the same stage. So we are living in a period of major structural shifts, and these shifts will be having a profound impact on the functioning of the economy, including the financial system. And therefore, they will also have an impact on our work as central banks and as supervisors. And besides giving you today an overview of some of these challenges, some of these major challenges that we are identifying, and identifying also their profound implication that they have for price stability and for the soundness and resilience of banks, I will also take the opportunity to present to you in more detail how we tackle such challenges by focusing on one of them. Time will not allow to go into all the challenges, and take you, if you like, a little bit on a deep dive in our climate and nature related work. Now, before I do that, let me give you a little bit of bird's eye view of the major challenges that we see. And after a series of unprecedented shocks, including the pandemic, Russia's invasion of the Ukraine, and the energy crisis, triggering inflation that was way too high for way too long, we are now expecting that inflation will converge back to our 2% objective in the second half of 2025. And the increase in ECB policy rates between July 2022 and September 23 has contributed significantly to this process of disinflation. And based on the prevailing inflation outlook, it was appropriate to moderate the degree of monetary policy restriction by lowering policy rates with 25 basis points in June and in September. Yet looking ahead, there is no room for complacency. The economy remains subject to several significant transformational structural shifts, including changes to the geopolitical environment, as all of you know, a rapid technological development, and the ongoing climate and nature crises. As was underlined by President Lagarde in a speech recently, the effectiveness of monetary policy is intrinsically linked to the evolving structure of the economy. We must be ready for change and be prepared to use the flexibility in our frameworks as necessary. And this is both relevant for our monetary policy objective and for the objectives of our banking supervisory role. So you will not be surprised that these big structural, macro, financial themes are also very much reflected, and that you see here on this slide, in our multi-annual priorities for ECB banking supervision that you see here. And I'll highlight some of them just for your convenience, so you'll see them there highlighted. And as a member of the executive board, and you know, the chair today already said that, and vice chair of the supervisory board, I'm involved in both the monetary policy and banking and supervision responsibilities of the European Central Bank. So let me, as I said, take the opportunity to dive in one of the common challenges that we identify and present here under both pillars of our institution, the central bank side and the supervisory side, and talk about how we take that into account, how we take into account the climate and nature crises. Now, to avoid any doubt, let me just make clear one thing before I really dive into this, and we dive into this together. We are not climate and policy makers. It is elected officials who make climate policies, who sign the Paris Agreement, who agree on the European climate law, who agree on a Fit for 55 action plan, who legislate the nature restoration law, etc., etc. That is not us. We are climate and policy takers, not makers. However, when we pursue our monetary policy objectives, our price stability objective, and the objective of safe and sound banks, we do look, sometimes I put it in this way, we do look out the window and we see what is happening. We see what is happening in terms of climate change, and we see what is happening in terms of how governments react by having climate and nature policies. Now, when it comes to global heating and nature destruction, central banks and supervisors can no longer ignore what is happening out there. And that is why we have a role to play. Because, and I think this is key, here you see how we normally think about this, by the way, physical risks, both in a chronic and an acute way, and transition risks. The physical risks, the floods, the droughts, the wildfires, and the transition risks, the reactions that governments, and by the way, also consumer preferences have to that. Both are drivers of risks, and many of those financial risks, and therefore relevant for us as a central bank and supervisor. Actually, I would go as far as to say that it is not just a question of, is it beyond our mandate to actually look at this? And my clear answer to that is no, it is squarely within our mandate because of the reasons I just mentioned. But I would go as far as to say that us not looking at the effects of climate and nature destruction were to be under-delivering on our mandate. So there are at least 5 specific macro financial transmission channels from climate and nature related risks, why central banks and supervisors take interest, and I've summarized them here on this slide. Now, for the sake of time, I will not go into them separately and only underline their main conclusion. These are all reasons why the objectives of monetary policy and banking supervision benefit from an orderly transition relative to a disorderly or a no transition scenario at all. Actually, the ECB has done a macro stress test some years ago with a very clear outcome being that kicking the can down the road will only make things more volatile, economically, in the end, more costly. So an orderly transition is much to be preferred from an economic point of view. Now, through these transmission channels that I just showed, climate and nature-related risk impact all our tasks and responsibilities. As I said, our price objective stability, our price stability objective, I should say, the financial risks exposures on our own balance sheet, not to forget, but also the safety and soundness of individual banking institutions and the stability and soundness of the financial system as a whole. Now, this is why we assess across all our tasks and responsibilities how to incorporate climate and nature-related considerations, not just to the extent that we can do so, but as I said earlier, also to the extent that our mandate requires us to do so. We have to look at how banks manage all their material risks in as far as climate and nature-related risks are material. We cannot afford to not look at them. So let's first look a little bit closer at how we are doing this in the realm of monetary policy. As you know, we have both a primary and a secondary objective, and climate and nature are relevant for both. In the context of our primary mandate, it is first and foremost about assessing the risks to price stability. Now, recent research by the European Central Bank, for example, how heat waves impact food price inflation, and how heat waves can cause upside risks to inflation, is something that we now increasingly take into consideration. And you will also see in our monetary policy statements explicit references to that. At the same time, accounting for climate and nature is important for the management of our financial risk exposures. If it is not necessary from a price stability perspective to actively increase our exposures to climate and nature risks, we should avoid such risks. Now, in addition, there is our secondary objective, which is about to support without prejudice to the primary objective, so without prejudice to the primary objective of price stability. It says in the treaty that we shall support, which is a legal obligation, we shall support the general economic policies in the EU. And these general economic policies include the EU's climate objective as transposed in the EU climate law, which I already mentioned, and several complementary pieces of legislation, regulation, and policy. Now, back in 2021, we acknowledged the relevance of climate change for monetary policy by explicitly including this in our monetary policy strategy. And at the time, we announced an action plan with concrete steps to incorporate climate change considerations in our monetary policy framework. And this action plan, so again, we are talking 2021, this action plan covered all elements of our monetary policy tasks, including our monetary policy operations, macroeconomic and financial analysis, risk assessment, and data collection. Sorry, somebody is doing this, and I think it is. So 1 year after the conclusion of our strategy review, we announced a number of concrete actions, most of which have actually been implemented in the meantime. And at the same time, we have made a commitment to regularly review all our measures to assess their impact. And if necessary, we will adapt these measures to ensure that they continue to fulfill their monetary policy objectives and support the decarbonization path to reach the goals set by the Paris Agreement and the EU climate neutrality objectives. Moreover, we will also look into addressing additional environmental challenges within our mandate. Now, before moving, sorry for this. I wanted to go here. To the work we will pursue in the next years, let me give you an overview of what we have been doing on this other leg of what the ECB now is since 10 years, and that is European banking supervision. So here, what we did was create a roadmap. Sorry for this. Here we go. by publishing in 2020 a guide with expectations, supervisory expectations on how banks should manage climate-related and environmental risk. And this was based on conversations that we had with the banks in 2019, so the year before, where it became apparent that less than 25% of the banks under our supervision, so then you have to think about, about the 110 biggest banks in Europe, less than 25% of these banks had given serious thought to climate and nature-related risks. And at the time, there was already I would maybe say, still a nascent international consensus that climate and nature-related risks are actually sources of financial risk and therefore need to be managed adequately by banks like any other material risk. So we didn't think that less than 25% of the banks actually having done at least some work in this field was acceptable. So that's why we devised this longer term strategy and we came up with this guide of supervisory expectation. Actually, I'll take you a little bit more to these steps, but the broader tale is that we have used the last years to make sure that all the banks under our supervision actually get to the point that they are fully compliant with these expectations. So when we came with this guide, sorry, I'm going too fast. We just didn't just invent things, but we build on work that was had already been done in an international context. In 2017, central bank and supervisors around the world came together in what is called the Central Bank and Supervisors Network for Greening the Financial System, the NGFS, Network for Greening the Financial System. I was the first chair of this network. And there was already work being done, and there was actually an NGFS guide on how banks could manage these risks and how supervisors could actually then supervise how banks manage these risks. And when in the ECB, we devised our own guide, that was largely or to a great extent benefiting from that work that was already being done informally in that network that I just described. And it's not the end of the story, because actually the Basel Committee in 2022, the Basel Committee on Banking Supervision published also their guide, which then, of course, unlike the SSM guide, which has logically as a parameter the SSM, but the Basel Committee published a guide which has worldwide application on how to manage and how to supervise climate-related risk, and this was in 2020. Now, also here, as I said before, we are not climate and nature policy makers. Also here, we don't tell banks to whom to lend and to whom not to lend. That's not our role. So our expectations are about ensuring that climate and nature-related risks are adequately managed by banks. Just like banks are accustomed to managing any material risks. So in that sense, there is nothing new. The categorization of supervisory expectations that you see here on the slide are categories that are very recognizable for banks and for risk managers, also in other areas. So then we devised this broader strategy, and I will take you through that quickly. But we first asked the banks to do a self-assessment. So we say, could you please check where you stand today vis-a-vis these expectations that we have published in the guide in 2020. And since we asked them in 21, there was still quite a lot of work to do, and banks have been very honest and forthcoming to us, and I know for sure because they were very self-critical at the time. So they said there's quite a gap between what you expect here from us and where we stand today. And we said, okay, that's fine. We didn't publish this guide 20 years ago. It was last year. So we asked the banks to come up with concrete action plans. And when I said the banks, I mean, again, the, say, 110 significant institutions that are under our direct supervision. And we asked them to come up with action plans, how to come from their A, if you like, to our B. And we also asked, how long will this take? And banks said more, by and large, 80% of the banks says, give us to the end of 2023, and we will get this done. And then we said, okay, you know, we are going to be reasonable, and we're going to give the banks 1 more year. But we will then indeed expect that all these expectations as laid down in the guide are going to be complied with by the end of 24. So 1 year later than 80% of the banks had said that they could do. But we said, but we will make sure that that then happens. Then in 2022, sorry, this clicker is a little bit too complicated for me. Apologies. We did a thematic review because, of course, we are supervisors, so we don't just, you know, base ourselves on self-assessment by banks. We also go in. We thought this was a new but important and material risk driver. So we said we look at all the banks. We did a thematic review. That's the way we call this, is our term of art, but it's a horizontal review where we actually went to all the banks and we checked and we said, okay, there is progress being made vis-a-vis the situation in 2019, the situation in 20. So that's good news. But the speed of progress is not high enough. So if you extrapolate it in 2020 with that speed, we would not have had all banks being compliant with our expectations by the end of 24. So we said, okay, what we will do, we will set a number of interim deadlines and we will enforce those. And that is what we have been doing. So you will see there some other things. We did a climate risk stress test. We did deep dives on real estate. So there have been other things, but I will not bore you with all the details. But the broader strategy was this. We set a number of interim deadlines and we will enforce these interim deadlines. And also there we want to be proportionate. So the first interim deadline, actually what banks needed to do there was to sell a materiality assessment, which is actually a very basic first step in any risk management, is that you try to find out whether, you know, the risks that you are looking at are material, which means that you have to look at your balance sheet, your activities, the products that you have, the geographies where you are active. And what we saw is that a number of banks, even in 23, so quite some years later already, had not yet progressed to the point that they had done that materiality assessment in a sound way. So some banks, of course, some had done that, but others, a number, had done maybe just some geographies, but not all, or some of their products, but not all, or just looked at physical risk, but not at transition risk, or the other way around. So that is where we have been more forceful. Let me go a little bit quicker through my slides here. So indeed, as I said here, you will see actually all that by the end of 24 would be nice if all that were green. This was the situation in 2022 where we said, okay, the glass is filling, but it's not yet half full. Banks need to do more. And that's when we started setting these interim deadlines and enforcing them, because that is actually what we announced and what we are doing and what we are using is an instrument which we call periodic penalty payments. So we have issued a number of combined decisions, is a legal term, but part of that is the possible imposition of a periodic penalty payment, which is actually basically in non-legal terms, you know, a formal decision by the supervisor saying that certain things need to be done by a certain date, and if not, you know, every day after that issue is not solved, a penalty is being incurred to a certain maximum, and that's crucial. In the end, after, you know, a bank, of course, can go to the court if they don't agree with this, etc. But at the end of the process, if that holds, it is being published. Now, of course, as a supervisor, that's maybe also something to point out. We are not driven by the wish to impose periodic penalty payments. This is a means to an end. What we are trying to do is to make sure that banks manage all their material risks. So we are very much aware that we have a privilege as a supervisor, because we can look, if you like, in the kitchen of all these individual banks, which of course an individual bank cannot, because they are their competitors. So what we have been compiling over the years is good practices that we then, on a no-names basis, but still give back to the sector and say, you know, these are things that we see out there. and to encourage, but also to facilitate the process. There's no need for each individual's bank to reinvent the wheel if they can just learn from wheels that have been invented already elsewhere. So we've been publishing these good practices, and over the years, also in the future, we will continue to do that because indeed, again, our goal is to just help banks get to the point that they manage this important risk field. And the good thing, by the way, was that already in 2022, we saw examples of each of the expectations already being met at the time, but at least one bank under our supervision. So we had concrete proof that it was possible. We just didn't see any bank that was fully compliant with all of them. But we saw that, and the interesting thing also at the time was that this was not just about, some big banks or some very, the small banks maybe being able to do this, but we saw good practices in big and small banks in different jurisdictions, banks of different business models. So we were and are rather convinced that what we are asking is actually, very much doable. I think I went through this already. Maybe to be a little bit more specific, so the first interim deadline we set was by March 23, where we asked these materiality assessments that I talked about. Then the end of 23, we are now in the process of assessing the follow-up, and then by the end of this year, so we are approaching that moment. We expect full compliance by all of the banks. So also beyond 24, this will still be a priority. Also because there is new legislation in terms of disclosures, in terms of transition planning. So we will keep this high on our agenda. And maybe that gives me, and this will be the last part of my introductory remarks here, our Climate and Nature Plan 24-25. So here, what we have decided to do is that we build on what we have done so far, and we will further develop this. Here you see an overview of some of the major achievements of the work in the last 3 to 4 years that we have done. I don't know whether you can read all those, but it's also on our website if you are interested more in the details. But it is actually to show that there's a wide range of activities that we do, and some of them are really in the very technical realm. So what is the data that we ask? How can we, in the central bank side, how can we adapt our mainstay economic models to make sure that climate and nature related aspects are being taken into account? So maybe slightly less, seeable or visible, I should say, elements, but very important because it goes into the to the engine, if you like, of the work that we do. This maybe goes a little bit too much into detail. Maybe there's one thing in banking supervision that is still interesting, maybe also to mention, and that is that we also in our fit and proper. So if you become, and then this, of course, something that I know that also here in Ireland has gotten a lot of the attention, the fit and proper aspects of the work of the supervisor, but also there's a guide that we have so that people that go through this process know what to expect, and that banks know what we expect. Many aspects there about diversity, about knowledge, about many things, but also there now we typically ask questions on people's knowledge on many different risk categories, but also climate and nature related risks. Maybe here to be a little bit more specific. So the first area of focus, so this is again for the next years, will be on identifying the requirements for the transition and the costs of delaying it. We will continue to explore what the transition means for the economy, including the financial system, and to consider how we can support it within our mandate. In the context of the second focus area, we will invest in improving our assessment of the impact of climate and nature events on the economy, including the financial sector, and this includes work on improving data availability that is crucial for analyses of climate and nature risks. And the third focus is about stepping up our work on nature-related risks. So far I've been talking, generally about climate and nature-related risks, but it's maybe interesting to explain that we have done research at the ECB quite broad, where about a year ago we looked at a database that we have with 4.2 million firms in Europe. So not just the big ones, but also the medium-sized and smaller, 4.2 million firms. And we asked ourselves the question, to what extent is their business model dependent on what we call nature-related services? So think clean water or water in general for cooling purposes, or for irrigation, pollination, carbon sequestering by forests, mangrove forests that are a natural protection against shorelines, etc. So science has defined about 30 or 32 of these nature-related services, and we asked our question: do firms depend on those? And the finding, I thought, was very revealing. 75% of firms in Europe are, for their business model, to a high extent dependent on one or more of these nature-related services. So we take those for granted, and if we knew for sure that these nature-related services were stable, then this would not be a cause of concern. But of course, we know that they are in rapid decline. And we went one step further, because we didn't just look at these firms, but we also looked at the bank's exposures to these firms. And now that, of course, as we know, Europe is quite a bank-based system, maybe unsurprisingly, we found that about the same number, 3/4 of bank loans, are to firms that are highly dependent for their business model on one or more of these nature-related services. So we will be doing more work on this. To again bring this in the realm of our mandate, understand it better, and this is this third part of our focus areas. I have no clock here, but it feels as if 20 minutes have been reached, more or less. So thank you, and I'll be sitting there, but I will be trying to answer questions today. So thank you.
Good. So just to remind our speakers, central bankers, that this is all on the record. It will go on our website. I know you know that, but central bankers, a misplaced word can lead to a lot more consequences for central bankers than the rest of us. So we might just, over the rest of this, 3 follow-up questions, Frank, if I may, before handing over to Sharon for some thoughts maybe on matters more domestic. And then we'll go to questions. Those who are online, the earlier you put your questions in, the more likely we are to cover them. So Frank, the first of my questions, nobody knows issues of sea levels better than the Dutch. As a Dutchman, have you noticed anything in terms of how mortgage issuers and mortgage insurers are behaving and pricing low-lying properties? A 30-year mortgage and mortgage insurance for a property that's close to the sea, even a small rise in sea levels could lead to more frequent flooding. Have banks and mortgage insurers changed their behavior, changed their pricing? Is there any evidence of that?
So this is a very relevant question, and it goes to the core of the things I've been trying to hint at. So sound risk management of climate and nature-related risks includes, of course, looking at physical risks. Flood risk and sea level rise are clear manifestations of these physical risks. Flood may be more acute, sea level rise may be more chronic. So within my intellectual frame in the slide, we are seeing banks starting to do this, I think we could see more of that, to be honest. But the difficulty is, of course, so I don't want to underestimate when I talk about it, what banks need to do, make sure that they are in compliance with our expectations in terms of how they have to manage these risks. Traditional risk management, to a large extent, of course, is looking backwards and compiling data, on mortgages over many years, many decades, and having models that help you understand these risks. Now, the risks that you mentioned, of course, require forward-looking risk management techniques. You have to peer in that foggy future and to try to extrapolate what we are seeing now, listening to climate science, seeing that these things are non-linear. So it's not easy to do. So what do? You work with scenarios, and you do stress testing. So there are these more forward-looking risk management techniques, and I'm convinced, and we are seeing evidence of this. But again, I think this is a journey, and we're not at the end of the journey of banks becoming more and more sophisticated in understanding these risks, and therefore then also, of course, pricing them. But it's very granular. So, I was told, for example, to take an example, because this is not just in Europe, of course, from Miami, where it really makes a difference whether you finance real estate on one side of the street or the other, in terms of flood risk. Because it's just, it's like 3 or 4 feet higher, and that is the difference between, the likelihood of flooding being much, much higher than not. So you need these data, not just on the zip code, but maybe even more granular. Now, there are, of course, an increasing number of external data providers where you can buy this data. So what we are seeing is, I think, a journey where banks become more sophisticated as this. They see this, and we are pushing them, as I said, to make sure that they manage these risks in a very, in an adequate manner, in a professional manner. But it sets them up to also reap the benefits from this. Because if you're good at managing these risks, you can, of course, then also take these risks in a controlled manner, in a well-capitalized manner, a well-managed manner. And let's face it, we should not forget that the whole green transition and the adaptation that is needed to the climate change will require trillions and trillions of investment. And part of all that will be financed by banks. So it's not just a defensive story. It is also a story of making sure that you're ready to contribute and to reap the benefits of how we, and I mean we as humankind, in the years and decades to come, will grapple with something that we know is there.
Good. Well, we live in pessimistic times, so maybe a more upbeat kind of question in terms of a positive scenario around artificial intelligence, which you mentioned earlier in your presentation as being one of the big changes. Do you folks in Frankfurt sort of look at a productivity surge caused by artificial intelligence that could grow us out of a lot of our problems? Is that a scenario that you've looked at as an upside risk that we're looking at? And maybe just to bring a sort of central bank element to it, what might that mean for equilibrium interest rates?
Right. Well, these are very big trends that we are maybe still at the very beginning. So I think that what central banks normally try to do is to start understanding this. I don't think that we are today in a situation where we can give big projections on what all of this means. It's very difficult to think that this will not have impact on many things. But it's early days. But it's not early days in terms of us not having taken notice and having, so we do dedicate resources to understanding what this all means. But it's very difficult to.
I know, absolutely. But what's your sense? Are you an AI optimist or pessimist from an economic growth perspective, at least?
Well, in my job, I've learned that maybe neither of the two. more generally, not just in terms of technology, is one has to be very realistic. But realistic sometimes means that you realize that certain developments can go very fast. There are tipping points, not just in climate, but there are also tipping points in technology. There are tipping points in public opinion. I don't know whether optimism or pessimism are very useful compasses in the work that we do.
Okay.
We are skeptical when we supervise, and we try to be. And you've heard the president say this many times in the press conference. We try to be rigorously data-based when we chart our way forward in monetary policy. And data-based, and more generally, of course, it also means science-based. And maybe then combining these two things. Of course, AI plays a big role also in climate science. We are not climate scientists ourselves, but we listen very carefully to what the IPCC publish. We look very clearly at what climate science brings us, and the message is there. Again, I'm thinking about this now because you used the word pessimism and optimism. Also there, I would not want to use these words, but if one is realistic, the picture is rather grim. We are presently on a 2.93 degree pathway worldwide. That's not 1.5. It's not 2. It's 3. That's based on present policies. It's based on the assumption that governments will implement all their stated climate policies in time. That's not, to put it very mildly, a given. That will always happen. Realistically, looking back, it is also not something that has always happened in the past. This 3-degree pathway does not include tipping points. Science is relevant. Data is the basis of what we do. Artificial intelligence will play a role there, but you're asking a little bit too much of me if I can now predict what that all will mean.
Okay, look, my third question, which maybe we'll push, we're running short of time. I want to hand over to Sharon, but just if we do get to it, it's another tipping point. Have we reached a tipping point in electric vehicles? And in terms of what that means for the auto industry in Europe, are there asymmetric shocks around that? Clearly, the auto industry is concentrated in certain parts of Europe. It's a very big industry. And then what does that mean for the financial institutions that support the auto industry? Is that risk, could we have an absolute catastrophe in the auto industry as Europe loses out and China surges ahead? Is that a risk, and what might? But look, let's come back to that if we have time. Hand over Sharon for her remarks so you can think about that, Frank.
Well, the Carjatá, so down or Mavet and you. Hi, everyone. Delighted to be here. Thanks to Dan and the Institute for having us. Always lovely to be here. Thanks to everyone who's joined us and those who are online, who of course don't have the benefit of being in this beautiful building, which I love coming to. Anyway, I know we're very pressed for time, so maybe I'll just say a few brief things. So the first thing is to connect the work of the ECB to our work here at the Central Bank of Ireland. So obviously we're deeply embedded in the Eurosystem and the work we do together around monetary policy. And from a banking supervision point of view, in the work that Frank has described on many different aspects. But of course, the Central Bank of Ireland also has a much broader mandate, having maybe some direct financial stability powers, like our mortgage measures, for example, that don't apply to the ECB, and also because we have a wider regulation and supervision responsibility for financial services, covering all of the sectors, insurance and funds, etc., but also other aspects like consumer protection and anti-money laundering. So I think much of what Frank says applies to us, but we also have this maybe broader context to our work as well as our domestic focus. And maybe two important things I think that are relevant for Ireland, and I'll come back to the shocks or the structural challenges that Frank mentioned. The as we all know here, Ireland is a small open economy, and how we're exposed to some of these changes, the structural ones in particular, but also the fact that Ireland has a globally oriented financial system. So while we have, of course, important domestic players, much of our financial services sector is actually internationally oriented. So I think the shocks that Frank had on that very nice slide about geopolitical risk, climate and nature related risks, and digitalisation, you've just been asking a little bit about that, and also to some extent demographics, which we haven't really touched on today, but is also very important. These huge structural changes that are happening are very much on our agenda too, as the Central Bank of Ireland, and particularly looking at Ireland through these lenses of our economy being a small open economy and our globally oriented financial services system. Because I think, as Frank said, all of these things really are core to our work, because ultimately they affect the economy and the financial system. And I think all of those risks and uncertainties are really driving much of our thinking, whether it's our economic work, our advice to the government, etc. And you won't be surprised to hear me say that central, I think, to all of these things is the idea of resilience. So whether that's resilience of the public finances, topical in the context of the budget yesterday, the resilience of the banks, the resilience of the wider financial system, the resilience of corporates and small enterprises, and also the resilience of households. And I think that idea of building resilience because of these structural changes, and also because we know risks can emerge that we haven't necessarily prepared for. So of course we all thought about pandemics before, but we didn't think it would manifest itself in the way that COVID did. So it really brings home the importance of resilience. And maybe an aspect of resilience, which goes a little bit to your point about AI, Dan, of course, the central bank has been very focused on financial resilience for the last decade, rebuilding the financial system after the crisis. But operational resilience, when you think about digital, cyber, AI, etc., I think is much more to the fore in our work at European level, but also our work domestically. And then my last word is just about opportunities, because I do think there are important opportunities. You know, central banks often focus on the risks and how we need to manage and mitigate them. I mean, I think for Ireland, there are opportunities. We have obviously a huge tech sector here. So in terms of digitalisation and the like, there are opportunities from climate, also in terms of, you know, wind and the like, as Ireland adapts in terms of supplying energy. But I suppose from our point of view, it is about getting this balance right between the risks and the opportunities and having that resilience.
This podcast is brought to you by the IIEA, sharing ideas, shaping policy.